We think there's a range of lots of different outcomes over the second half and certainly into 2025. And that's why we think it's incredibly important to be discerning in the types of companies that you would look to invest in. If we look at the global equity market performance over the last recent period, so 1 year up 25%, since the pandemic up 60%, that is unbelievable annualized returns year on year. And so with that backdrop in mind, you can understand why investors might be thinking, where can it go wrong? What are the risks? And so, we've had slight hints of things that could have gone wrong. So, of course, we started the rate rising cycle where there was a concern around how the consumer might react to 500 basis points of interest rate hikes. And the consumer navigated very well with the help of the Fed and the handouts that they saw through the pandemic. And, of course, global equity markets have been helping there too. We've got some certainties on the one hand, so we do look to have peaked in rates. On the uncertainty front, we've got the US presidential elections, we've got geopolitical tensions, and then we've got a waning consumer demand environment globally, really, as consumers have battled with these higher interest rates. And so can the Fed navigate what is really quite a challenging time to make sure growth continues to stay as resilient as it has? Irrespective of what happens, we think that it's really important to find businesses that are incredibly resilient, that have strong balance sheets, and that can navigate any type of macro environment. There's three main things that we need to think about. The first one is that the Mega 7 have been such a strong driver of returns, market returns over the recent history, and we think that can continue. The second thing is that we're likely to be in an environment where interest rates stay higher for longer. And the third one is that you need to be thoughtful and picky in the stocks that you choose. I'll elaborate on each of those. So the first one is that the Mega 7 companies have been delivering unbelievable growth over the last recent history. That is not the case across the whole space, particularly more recently. So you've had NVIDIA, for example, year to date, that has delivered over 120% growth. That's a third of the whole S&P 500 returns this year. Apple, on the other hand, is flat. So you've had real divergences between the companies within that space. And so we think that NVIDIA, being a high conviction company in our portfolio, can continue to deliver strong performance over time. That's because we think that the market is underappreciating the growth that they can deliver over the longer period, the resilience of that earnings, and the fact that we're only just started with them being really at the sweet spot with no other suppliers coming on board in the near future. The second thing I think we need to be aware of is that we're likely to be in an environment of higher rates for longer. We have seen inflation starting to cool, but more recently it feels as though it's not quite as quickly as the market is anticipating. What does that mean to us as investors? Well, firstly, that impacts companies with higher amounts of debt. That's definitely not the kind of company we tend to look for in our portfolio. And the second thing is that all these companies have enjoyed a lot of pricing over the last 2 years. That's the tide that has lifted all boats. And now that the tide has gone out, you're starting to see who the real winners are. And that is the companies that can deliver volume growth against waning consumer demand. And so once again, that's those businesses that we like to talk about, those strong, resilient, sustainable growers over the long term. I would characterize our portfolio in 3 different buckets. The first part is how we like to think about it as the high quality core compounders, businesses that are sustainable, provide us with resilient growth irrespective of the environment. They grew through the global financial crisis. They will continue to grow through time. These are businesses like Visa, payment company, insurance broker Marsh McLellan, Intertek, inspection and testing company, very strong companies, and really protect the capital that we're trying to invest. The second bucket is companies that are invested in the big mega themes selectively. So companies, for example, that are investing in AI and benefiting from AI, companies like NVIDIA, ASML, Salesforce, and Adobe are all benefiting from the same theme of AI. Then we've got the theme of obesity. This is an untouched, never been invested in opportunity. We've got Novo Nordisk, which is one of two leaders in this space to be able to capitalize on the significant opportunity. You've got 1 million obese population being treated, and yet there's 800 million that can be treated today, which is expected to double by 2035. Novo Nordisk is really in the sweet spot of being able to deliver with that growth, and is at least 5 to 10 years ahead of any competition that might enter the market in the coming years. And then the third bucket is a real niche part of our portfolio, which is investing in those differentiated businesses. They tend to be more mid-cap, they tend to have higher growth, and they tend to deliver us that extra kicker of return into the portfolio. We see them as the future leaders of tomorrow. These are types of businesses like Advanced Drainage, which is a stormwater drain company. They've also got an ESG component where they're using recycled materials to make the stormwater drains. So we think we're really well placed looking forward with a very wide, diverse range of excellent businesses that can grow in all types of macroeconomic environments.